Hello, welcome. Thank you for joining us for this week's update. We're gonna go, as always, through the cross-asset class analysis, and we will update you on our positioning and what we are currently holding and what we plan on doing for the upcoming week. It's been a good week for us. We've closed our week 2.5% up on the week. So we've dodged the bullet with Nvidia. I really wanted to sell a strangle on Nvidia, but I didn't. Instead, I sold it on Snowflake, and it proved to be a very good decision because anybody who was short volatility coming into this print has gotten absolutely annihilated. Poor guys, poor people. We had our initial linear position on Nvidia, but we closed most of it. We had, what is it, if I'm not mistaken, 5% total allocation to the Nvidia, and our average price was around 265, somewhere in that region. We closed 75% of the position right here, right on this day, and of course, and we left 25, and we closed the rest of the position right here. I wished we would hold the whole position into the print. We would have made much more money, but it was. I'm very grateful for that anyway. Okay, let's leave that aside for a second. And let's start, as always, with currencies, with rates, because the most important dynamic in the market right now is the rate increases or decreases. And regarding that dynamic, we have two different branches. It's either Fed expectations, market expectations of the Federal Reserve policy, or debt ceiling. Debt ceiling is a exogenous risk. We just have to wait and see. We just have to wait and see what's going on there. So, in regards to rate expectations, we are, and the last print of PCE inflation index that we've gotten on Friday had shown acceleration from 4.1 to 4.4%. The expectation was for 3.9. We are in a period of structurally elevated inflation due to the nominal wages rising and productivity being around 0%. So this is your structural level of inflation. Until you get those nominal wage increases lower, much lower, you're not going to be able to squash inflation completely. So we are in this sticky inflation environment. These disinflationary forces that had come from the disinflation in food inflation, in supply chain problems, and energy inflation, those came almost fully came out of the system. Now we were left with this structural inflation level, the difference in between the nominal wage rise and the productivity growth. So this is our reality right now. And let not leave anybody aside. Bob Elliott highlighted this dynamics the most coherently and clearly in this last thread. The US economy has shifted from a supply-driven inflation shock to an entrenched inflation dynamic. Today's PCE report highlights how elevated income growth maintains elevated nominal spending, which keeps inflation well above the Fed's mandate. Core PCE inflation is still at 5%. The problem for the Fed is that the spending dynamic is pretty sustainable because it's financed with nominal income growth rather than falling savings or rising net borrowing. Without slowing incomes, the Fed isn't going to be able to break spending and with it inflation. This is the reality. So two most important dynamics that define the Fed policy going on forward is we knew that before, obviously, as unemployment and inflation. And inflation is largely impacted right now by employment data. Employment is cyclically at the lows right now. We've been observing some cracks in this employment and the cracks in the chinks of the economy a little bit, but not enough. Definitely not enough to even slightly shift the Federal Reserve bias. The Fed actions, which were behind the curve, led to a shock turning into inflation entrenchment. The result is that it will be a lot harder to durably get their mandates, to get to their mandate. When the Fed looks at the core CPI and PCE, they must recognize that they aren't making much progress, and this has been the reality that we've been highlighting for the, well, couple of months, going for a couple of months. Okay, we know that, and hence we had our long rate positions in place, and we closed most of them this week. Last week, meaning on Friday, we closed most of them. Now we are the only position right now that we have is the long dollar position, and we closed that one by 25%. We booked our gains. We went long Dixie, if you remember, right here at 102, somewhere around that region, and we closed 25%. I do believe that this move still has room to go, and if we get employment data, which is going to be coming up this week on Friday, non-farm payrolls, very important print, and CPI is somewhat elevated, and employment is still at cyclical lows, I don't think it matters much if employment will came out at not at 3.2 but at 3.3. No, it's not going to change anything. It's going to be all totally fine for them to raise by another 25 basis points. And if you look at the CME, not this one, CME Fed Watch Tool, and the probabilities, there are probabilities in place right now. 64% for the increase right now. So finally, at the beginning of the week, in the update, I said that I was mistaken. I said it was 14%, but it had risen from 14 down up to 64 by the end of this week. And right now, I think the probability will stay around that region. So I don't expect much of a move in rates this week, or in dollar therefore this week, until Friday. If we get Friday report, we're gonna get another spike higher probably, and this one will probably shift upwards of 70-80%. And I believe they're gonna raise. They are going to raise by another 25 basis points, and if they do that, that is not gonna be good. We are at that very shaky point right now where we go into retest our cyclical highs on all of our rate metrics in Europe and in America as well. So it's definitely not going to be good. And the dollar by that point should retest 106 again. So we are looking for that, and we will be preparing for it. All I'm expecting and all I'm waiting for is a slight retracement at the beginning of this week. Slight retracement in dollar, slight retracement, just a normal within the probabilities of probable ranges. It's normal to see the retracement right here. It's normal to see the retracement in gold. It's normal to see the retracement in silver. It's normal to see retracement in everything rate sensitive, and then rates themselves. It's totally normal to see that. And if we're gonna get that, I am going long rates once again. With positive carry, meaning I'm not going to be buying puts on TLT. I'm probably going to be selling another calls on TLT. We've been very fortunate with our positions on TLT. We've been long TLT since the beginning of the week. We've been selling puts at the test of trends right here, right here, right here, right here. And when we saw this break in trend and break in trades on TLT, and the whole rate complex that we've been pointing out a couple of weeks ago, that it's looking like the whole rate complex is turning around. We started to sell calls. We've sold 106 calls. We rolled them down to 104, and right now we closed all of them. And on any bounce right here, I'm probably gonna sell another bunch of 104s on TLT. We shall see. This is our expectations coming into this week for the TLT, for the rates, for the 2-year yield, for the 3-year yield, bullish trend, bullish trade, and the most important dynamic that identifies the next path forward for the rates overall, for the rate complex overall, is the Federal Reserve dynamic and the market's expectations of the Federal Reserve policy. And I believe we either in consolidation mode before the employment report and before this CPI report, and before the Fed meeting itself. Long 10-year, long 30-year, long 2-year, PFIX. We use PFIX as a measure of, as an alternative to the MOVE index because it's tradable. Our fractal and our volatility adjusted signaling process is much more effective on the PFIX than the MOVE, because the MOVE is like, I don't know, applying technical analysis to the VIX. You're an idiot. Same thing with the MOVE. But PFIX is a different thing. PFIX is simply reverse of the MOVE. It used to say that because it's just a long option, long 7-year option on the rates. That's it. So when the rates rise, implied volatility for the bonds increase because the bonds start falling. When the rates fall, implied volatility for the bonds tend to decrease because the bonds rise in price. So that's natural dynamic. And PFIX is also signaling bullish trend, bullish trade. And if we get a chance, we would buy PFIX once again at 65, maybe somewhere in that region. I don't see this week is being as impactful. This upcoming week has been as impactful as the previous week, because this debt ceiling dynamics right now. Yes, we just leave it aside for a second, but the reality of the debt ceiling dynamic is that this X date is probably not going to be on the 1st of June. It's probably going to be at maybe 9th, 10th, 11th. I've been reading a lot of stuff from people that really know what they're talking about, and it's not on the 1st of June. It's somewhere around 9 to 15th of June. This X date is going to happen, and I have no insights to provide us. What will happen if they're not going to reach an agreement? What will happen if they will reach an agreement? I'm just seeing what the market is pricing in right now, and we're just following the market, following the overarching dynamics. That's what we can do right now, very cautiously, I must add. So PFIX, and once again the whole rate sector, rate sensitivity sector, implying another repricing lower, because right now we are at the low end of the risk range on the TLT. If you look at the TLT, but I believe that any bounce this week is meant to be sold into. So this is our position, and this is what we will be doing. If you want to play that with TLT, we will do that as we do it. We're probably going to sell calls on TLT. That's it. As the long end, we're probably going to just sell calls on TLT. That's it, because there are the different positions to be had across different asset classes, because different asset classes are impacted differently by the rates. That's it. That's for TLT. Same thing with the 2-year yield in Europe, with rates in Europe, and the long end in Europe as well. We've been calling for this repricing of rates higher and higher and higher. We've been very surprised by this move. Very surprised by it, to be honest. It didn't break the trend level, but it did broke the trade. We wasn't prepared for that, so we closed off our 5 BUS positions. These 5 BUS is the ETF for essentially for long ETF of the 10-year yield, chart replication of 10-year yield. And with what we've gotten, we have squarely signaling that we will get 10-year yield in Europe, and the short end of the curve in Europe, short end of the curve. Oh my God, retesting its cyclical highs. And generally, if it was 2022, I'd say, holy shit, this is so negative for equities, sell equities. Same thing in America right now. This absolute indifference of the SPY, of the SPX, of the equity market overall to the rate dynamic right now is astonishing. Absolutely astonishing. If it were 2022, the market would have been down on this Friday, by 2 or 3%. But right now, the market is absolutely indifferent to what is happening in the rate complex, which is the correlations break. Why? It'd be very nice to know why. I don't have the answer right now. We just know what we're seeing. As to the equity, let's leave that once again for a second. Europe. It's not good. It's not good. The reality of such an increase in rates is not good for European markets, definitely, and European economies, definitely. Look at the gilts market. I mean, we are at levels where previously we've gotten our a pension fund crisis in Europe, where the central bank had to step in, provide liquidity, and reverse their policy at the time. We are in the same area, in the same region. Yes, the velocity of the move is not of the same magnitude that we've seen right here, but the velocity doesn't matter if we stay at that level for a long time, for a prolonged period of time. And by the looks of it, we are going even higher. And now, as the Russell Napier, if anybody follows his work, says, it's all going to be defined by the simple ratio. The cost of servicing the debt to the private sector income. And if the cost of servicing the debt to the private sector income is above 20% or somewhere around that region, with a big increase in interest rates, you're going to get problems. Over time, you're definitely going to get problems. And we've already, in this period where people say monetary policy works with lag, it does, and we are already 6 months minimum into that process. So it's around 9 to 18 months, and by the fourth quarter of this year, we're gonna be in the heart of it, in that period where we should feel the impact of monetary policy the most. By the fourth quarter and the first quarter of the 2024, we should feel, theoretically, the real economy should feel the most pain. But rates did not stop rising; they are continuing to rise. And in Europe, in France, in Europe generally, this ratio of cost of servicing that to the private sector income is around 20%. In China, the same thing in China, and the same thing in the US. So I think we're just waiting for something to break once again. But what will it be? And the dynamics of this cycle is incredibly different to what we've seen in 2008 or in 2022 or in 2020. Because anything and everything that will break in the financial system, we will get the provision of the liquidity by the central banks instantly. It's not going to be like in 2008 where they waited for 9 months and only then started providing liquidity, and then we've got another rally. First of all, we've got an incredible drop in S&P. The last time we had liquidity and credit crisis, well, we got this response from the market, because the Federal Reserve stepped in and on the next day opened up the floodgates. So if anything breaks, it's I am surprised to say that, but it's probably positive for the market. We shall see how we're gonna trade this one. But we are with such a bipolar situation in the markets, with such indecisiveness. We're just looking week after week. We're just positioning the week out and see what we want to do this week, and we are totally fine with closing out all our positions on Friday and coming into the week with a fresh slate. So clean. I don't know. This is the reality. No clear direction once again. So we're just waiting for something to break, I guess. Something new, something. But I have a hunch that this cycle will not be about the credit problems or private sector problems. It's going to be about the government and the inability of the government to finance themselves. And this generally tends to play out a little bit longer. So, and what effect will it have on the equity market? I don't know, because I haven't been trading through this. We haven't seen that for a long time. Last time we've seen that is after 1945, in that period, from 1945 to 66, from what was it? From 1901 to 1929. I don't know. It's been a long time since we've seen that. So incredibly frustrating not knowing what's going on, to be honest, and how to explain. And I've been reading and doing our research. I've been reading a lot of people who should know that stuff. And generally they can explain the general dynamics, but no one can fit. I haven't found yet the description of this cycle that can fit into this one. I've been picking some from Russell Napier. I've been picking some from the other guys that I'm listening to for the Ray Dalio. I'm talking about the not the cyclical dynamic, but the secular dynamics that are definitely going to be impacting the cyclical realities that we find ourselves in. I've been able to piece this whole together a little bit, but the direction is still not clear. So we're trading week after week, and we shall see where this takes us. So far, it has been the right call. This is the rate dynamics. Rates higher, even if we get a drop in rates, we are the buyers, meaning the sellers of bonds, and we are the buyers of sellers of rate sensitivity, and we're buying rates. We're buying rates. Credit, even high yield, but not that impressed by that repricing of rates higher. Not even close. Last time we had such a repricing of rates higher is we've gotten these moves, and another move in 2022. Right now, it's just slightly negative with bearish slope. No problem at all. Just nothing to see in high yield. Yes, we are. It just confirms our contention of repricing of rates higher, but it does not confirm to us the SPY short, SPX short, or equity short. It does not do that. Every time, this is the first, once again, it's the first breaking correlation, because every time the high yield had broken a straight trade, like right here, we've seen right here once again, we've seen a appropriate move from the equity sector, from the SPX as well. SPX with a little bit of lag, broken it straight as well, and we've seen a repricing lower in equities. Not this time. And so we have to adjust for that reality. So maybe it's not the right now. It's not the appropriate signal to be short of equity. Okay then, high yield EM. Emerging markets high yield bond ETF, bearish trend, bearish trade. Once again, long dollar. It confirms the long dollar because it's mostly correlated to the dollar, and it's bearish trend, bearish trade. Dollar up. Let's go. LQD, and once again confirms to us the repricing of rates high. And if you want to short something, you might be short of TLT, you might be short of LQD. We will be contemplating the possibility of selling calls on LQD as well. Senior loan ETF, same thing, confirms repricing of rates higher. Mortgages, they are in consolidation. Nothing to get from here until we get a meaningful another cyclical highs printed on 10-year yield. We're gonna see mortgages stay in consolidation, and they are staying in consolidation. So, but by the looks of it, what we are seeing right now and what we're expecting to see for the 10-year yield, we might see another retesting of cycle highs for the mortgage rates. I can see how that can be good. Okay, this is for the rates and for the currencies. Once again, we are still long of the dollar. Any drop in the dollar is to be bought at this point. Even drop to 103, around that region, we will be buying dollar. It will be a very generous offer in our minds. Same thing with, therefore you should be short of euro, you should be short of pound, you should be but the best currency to be short against the dollar is JPY. It has been the best currency. We've been calling for this, and we've been calling for CNH. If you remember, this has been an amazing trade. Just we absolutely nailed it. I'm very happy with that. We've been calling a potential repricing of CNH higher, of copper lower, of HSI lower, and it indeed happened. We wasn't as keen on shorting Chinese markets. We've been calling for a potential short right here. You can put on, it was up to you, but we couldn't hold ourselves, and I did buy puts on BABA, Alibaba Group, somewhere, yes, on that day, around that region, and I'm not planning on closing them at this point. I'm just contemplating and seeing what's happening next, because HSI is still bearish trend. We just might get just normal bounce of the low end of the risk range on CNH on the dollar, because if we get, but because the markets right now are very stretched to one, very one-sided and very stretched to one side, and it would be totally normal to get a retracement in the dollar. So it will be totally normal to get a retracement in JPY, in CNH, in copper, in HSI, and that would be just another opportunity to sell into that and buy dollar into that that move. HSI, oh, I mean, CNH, yeah, CNH is. I would not be surprised to see CNH falling back to 7, maybe even lower than 7, and we will be biased below that price. We shall see. We shall see if that will happen. But this is the underlying dynamics. Once again, the other thing that confirms recession, that confirms short on HSI, that confirms long on CNH, long meaning here, that confirms weakening of CNH, that in itself confirms weakening in Aussie dollar, and in itself confirms weakening in Australian markets. So this is the similar setup that we have right now between China and between Australia and between JPY and between the markets there, and between the dollar and between the repricing of rates high in America. Okay. And once again, it will be largely impacted by the non-farm payrolls coming this week, the upcoming week. Let me check what we have for the next week overall. Unemployment rates, consumer files. Yes. House price index. Nothing too important on Monday. And BS manufacturing. That would be interesting to see. Consumer confidence. A lot of Germany. Nothing. Oh, that would be also interesting to see. Okay, JOLTS, yes, JOLTS openings on Wednesday. Once again, another very important. We're gonna get volatility on Thursday, based on that in rate complex. ISM manufacturing on Thursday, and in non-farm payrolls and unemployment rate on Friday. So should keep an eye on Wednesday for JOLTS opening. Okay, the currencies, back to DXY, therefore, once again, short the Canadian dollar again. Yes. Well, these are the most important currencies right now. On the other side of the shorts, we are long the Nifty 50. Nifty and Indian currency weakening against the dollar, bearish trade. We've been in consolidation. I have no insight into the Indian currency, but I do have insight based on Nifty. We've absolutely missed this opportunity. We've been, if I'm not mistaken, we've been calling for a long around this trade level, but we've missed that. We totally missed that. But with all of that, I would be a buyer now at this point if we get a chance on Nifty. You can play that through EPI. EPI is the best, actually. Is the best ETF for that. So be long of India right now. Short of other currencies against the dollar. We might get a counter trend move at the beginning of the week. That's totally normal. A couple of words about the Bitcoin. Nothingness. Once again, nothingness after nothingness. It can move. It might move. It might do whatever it likes. We're still holding our longs right here. And if it drops below 25,000 right here, if it drops below, if it's going to retest 23,000, 24,000, it would be even better. We will be buying that. So, totally in consolidation. I'm not expecting big moves for Bitcoin, but if it happens, and if it happens to the downside, it would be another generous opportunity to buy into that weakness in our minds. Same thing with Ethereum. Totally the same thing with Ethereum. Drop below. I'm looking for the Ethereum to drop below 1700, and then we'll be buying that. We'll be adding to our position right there, right now and then. Okay, we've been through currencies. Oil in consolidation, and will continue to stay in consolidation. Unfortunately, we've been just shifting from one equilibrium to another equilibrium, from here to here, and probably just staying around here. Nothingness, absolutely nothingness. No position to be had in oil right now. we are relatively short of oil through the LNG trade. If you remember, we've been calling for selling calls on LNG. We didn't do that actually. We didn't sell. We've been calling for selling 150 calls right here, and we got a nice move, but we did not sell that. But we still like we still like LNG on the short side through the calls. US oil, relative short, nothing to do here, to be honest. In our position, in our opinion, we're not holding position right here. We're not seeing anything that can be extracted from this consolidation, because you cannot play oil as effectively as you can SPX, let's say. Okay, natural gas, same thing. Nothing to do there. But it continues to be bearish trend, bearish trade. UUN continues to be. UUN is interesting, but once again, I have no idea how we're gonna get a meaningful expansion from this equilibrium. We do like this spot, physical uranium trust, and in due time, it will get a move. We will shift from this equilibrium and probably move higher, just because of the fundamental realities concerning the uranium overall. But with this repricing of rates higher, that should be pushing us closer to the recession. This demand destruction that we are seeing, how the hell is this guy gonna give us a meaningful move to the upside? It's just been consolidating, just gathering liquidity from the top side and the low side right here, and consolidation. Another retracement and retest of that level would not be surprising for me. So I have no idea, honestly. If you want to gather a long-term, maybe a couple of years ahead position, you can do that. I don't know how much you have to pay for that. What's the commission for holding that one? I don't know. But right now, if I were to buy this, I would buy this at 1560. So that's it. That's our take on this one. URA, URNAN, TAN. Okay, gold as a very sensitive thing to rates, and I do like how gold on the relative basis is being less impacted by the rates. So this relative move in rates have not impacted gold to the same extent as I would have expected. Meaning the repricing of gold lower has been much more muted than we would have expected, and we like that. It shows strength, but it's bearish trend and bearish trade, and it means only two possible things: whether we are getting, as in that example right here, whether we are getting a fast and meaningful repricement of gold lower that in itself leads to problems, means that rates reprice much higher to problems, and then we're gonna get some, in turn, some things breaking, and we're gonna get repricing of rate expectations lower, and gold will do the same thing as it did right here. Or there is a second way it can exit the bearish trend. We gonna stay in consolidation right here for prolonged period of time. Prolonged period of time, in this case, means minimum month, 2 months, maybe 3 months, maybe 4 months. We shall see that. But we are not long gold at this point, and we are not planning on being long gold, especially coming into this week. So no. Same thing with silver. I do believe that this is an amazing opportunity to get long of silver. And if we get silver at 22, 21, and maybe even 20, we would be buying long-term positions on SLV. Definitely will be buying long-term positions, but right now, no, still short of silver. Still staying short of silver, and staying short of gold, and that's the reality. Platinum, another thing from the rate sensitivity complex, had broken trend. Even this guy broken trend. So, short of fiat alternatives. Copper. I don't see that there's anything to be done in copper. If you want to play this similar setup in between CNH HSI and copper. The best thing to play it with is through the HSI, obviously, and the CNH itself, but not the copper. Once again, because the commodities are notoriously hard to trade, and this move that we've been calling for short around this area, the most of it had already happened, I think. I've no idea, I don't know, honestly. I'm no professional commodity trader, but I don't see that there is anything to be had in copper at this point. But still, the most important thing is bearish trend, and it's negative trend and negative trade, so not good. Same with most of the base metals, DBB, bearish trend, bearish trade, and DBA is, well, in consolidation. It will stay in consolidation. Rates, we've gone through rates, and now onto the most important and interesting stuff, equity. ASXXP. This move in European rates finally had impact on the European equity and European stocks. So right now, this is the first time since the beginning of, let me move it away a little bit, since the beginning of this whole repricing of European stocks higher. This is the first time that we've broken trend. The first time that we've broken trend right here, and I'm not calling for longs anymore. I'm calling for shorts, either consolidation with downward sloping trend or a short, outright short for the ASXXP, for the IEV, therefore for the general European indices and equities. It's not a place to be in right now. It's not a place to be in right now. It's a short. It is a short. So this is a call for ASXXP. The other thing to be long of, on the other hand, is Kospi, Dr. Kospi, and India. Kospi and India. These are the things you can play through EWI or EPI. These are the things that we will be contemplating buying into the position. I don't think they're gonna give you or us a nice retracement for us to enter. So I shall see. We shall see how we're gonna play that. But these are things to be long of. Everything else in our minds is a short. Canada, Indonesia, Asia, most of Asia, Europe is a short. EWW, Mexico. We've been calling for longs in Mexico for a long time. Mexico is still a long. It tested its trend. You could have, if you would have, bought it at the test of trend, because the best level to buy anything is at the trend level. And we are still long of EWI of Mexico, but not to the same extent as we've been, because it is negatively impacted by the dollar. And if we are going to see the same move in the dollar, we're going to see a reprieve in the move of the dollar, so the Mexico should do fine. But if we're gonna get the same move in the dollar, in the rates higher, it's not gonna be good for Mexico. No. So Mexico, if we were to buy Mexico, we would do that at 60, somewhere around $60, because you have a clear stop right here for Mexico. Okay. The Nikkei, very interesting guy. Japan. We do expect now continuous repricing of JPY lower. This is positive for Nikkei, this is positive for DXJ. And if we're going to get reprieve in that move, you might get a chance to enter DXJ and Nikkei on the long side. So these are our calls, and this is what we're looking for next week. Long Kospi, long Nifty, long Nikkei, but wait for the retracement, which we're probably going to get because of the repricing of GXY a little bit lower at the same time with JPY, therefore strengthening against DXY. So you might get a better opportunity to enter into the Nikkei and EWW. Mexico is a short at this point at 61, but long at 60. So we're going to wait and see. Probably is going to stay in consolidation a little bit after such a move higher. And that's it. This is one of the important currencies and the important world equities. China remains long and will continue to go lower. With this move in CNH that we've been calling, and we are saying, if you listen closely, we've been calling for potential relief, in this move. And retracement or consolidation, which should be positive for the HSI and should be positive for most of the stocks in China. But it is still a short. It is still short, and we are looking to add to our short position on BABA if we get a chance at 86, somewhere around 86. This is the name we'd like to short. Same thing with, the general indices. Same thing, short FXI. Any retracement right here is meant to be entered to the downside. And the controversial take is for SPX and SPY. Bullish trend, bullish trade, and we've just had a run on trades on SPX. With that, I think we are entering a new phase where we're probably going to get repricing of this guy higher. We are calling for, let's open up SPX better, 4,300 at minimum, at probably 4,400 on SPX, on SPY at this point. So if we get a chance, and I think we will get a chance at the beginning of this week, I hope we will get a chance at the beginning of this week, the best place to sell some puts was on this day, obviously. If we get a chance and retracement a little bit lower, we will sell puts on SPX, on SPY and SPX. We will be selling puts on them. So we are staying long of SPX. We are at the same time, though. At the same time, we don't like diamonds. We don't like IWM. IWM ran its trend level and just generally not a good place to be in on relative basis. It is still long because bullish trade and just neutral on a trade basis. But it's not the place to be short right now. You don't short equity markets in America right now. Nothing is signaling that. But the underperformance of XLY, underperformance of XRT, underperformance of XLU, XLP, XLV. Look at this. All of these sectors are negative. The only thing that is positive is QQQ, and therefore, okay, don't go against the grain. Continue. Let's ride the trade and the trend. So we will be contemplating, and we'll be selling puts on SPY if we get a retracement lower a little bit, just a little bit. If it gives us this retracement, we will be selling that. In regards to the single names, we will be selling puts on Apple. And everything else is so much overstretched to the upside. I don't see how I want to be selling puts or buying anything at these prices. Meta, holy fuck, this guy just can't stop and won't stop. That's fine, it's totally fine. That's an interesting area to be looking at. Meta. And Meta is definitely going to get a nice move done. We're definitely going to get repricing of Meta lower at some point. There will be a point to be short of Meta, just to catch a trade if we can, like in Netflix right here. The Meta will give probably the same move of the same magnitude. Meta will do as well after that massive of repricing into the tail resistance. Just the other names. Honestly, I don't have other names to be long of. I do like Visa, very much so. I do like it. But we are testing trend right now with overall bullishness. I'm looking to sell puts on Visa and MasterCard as well, but they are underperformance and will continue to be underperformance. Unfortunately, now the tech is the thing, and Tesla. I hate myself just for saying that, but Tesla is a very interesting candidate to be long going into this week. So we shall see. I'm unfortunately not much insight. The only thing I can tell you is we're definitely going to sell puts on SPY, and you should not be doing this if you don't know how. If you don't know how to manage those positions. But we are neutral on everything else in the equity space in America, but we're long of tech. Yes, obviously. What's about what relevation? But don't short equity. Do not short equity. Nothing supports equity short in America at this point. On an immediate basis, nothing does that. Nothing supports that. So it's not a place to be short of anything in the US equity. Just don't do that. Incredibly hard environment, because the fundamentals pointed to the one thing, and the whole cross asset class analysis is pointing to the repricing of rates higher, which had an incredibly negative effect on the equities overall across the curve in the whole world to an incredibly negative extent in 2022. But this year, equities around the world seem to be absolutely indifferent and immune to the repricing of rates higher. We shall wait. We shall wait until the 2-year yield will break its cycle high. I shall see how the SPX will talk at this point. But overall, no very positive dynamic. Oh, home builders. It's once again, I wouldn't be long home builders. These guys have been outperforming, and right now, this is the first time since this whole move of and repricing higher that we are looking just as DHI, the biggest home builder. We are going to be in a consolidation or a downward sloping consolidation. So not the place to be in. We've broken trade. We've broken trend. No, not trend. We've broken trade. We are retesting trend right now. But if you want to be long off, if you do think that this is an amazing place to be, and you just and you think they're gonna continue to outperform the market, then this is the place you want to enter. This is right now. This is the place you want to enter at the trend support level. But we do expect something like this after the break of trend, after this continuous outperformance, after the test of all-time highs. Even if the market will continue to be positive, if the SPX will reprice higher, which we suspect it will, there's going to be a underperformance at this point. Some retracement, maybe consolidation, maybe another drop lower in home builders. We would expect home builders, without retesting its cyclical highs, to create a lower high of any form and continue lower and retest maybe 100 on the DHI. Lennar, same thing on the Lennar. The only difference being here that you might say, oh, we had the same thing right here. Look at this one. We had a break in trade coming into the tail resistance right here. Break in trade, and then what happened? Holy smokes. Amazing repricing. What we did here, we came into the after break in trade, massive repricing lower on the relative basis. We came into the trend resistant area. We've stood there for a couple of good weeks. We've taken out the liquidity lower. We've taken out a trend support, and that allowed us to break higher. Right now, the situation is vastly different. We are not long of DHI. We've been selling puts on DHI, but right now not. No. We do expect a consolidation and underperformance of DHI, Lennar, and this whole bunch. So this is our take on home builders. Same thing goes for Lennar. Okay. Nothing else to point out. Oh, Costco. We got so incredibly lucky. Not lucky. I mean, this is usually how Costco behaves. It opens up in consolidation, and at the end of the day, it continues to move and continues to reprice after the earnings date. It always does that. We've sold on that day. We've sold 19 and 20 and 16 Delta Strangle on Costco. We've booked 40%. On the open, in the first 10 minutes of the open, we've closed the position and booked 40% of the max profit, and we were incredibly happy with that. This is essentially what we've been expecting. So that was a good trade. Right now, Costco is the only guy from the XLP sector, from the stable sector, that is signaling bullish trend and bullish trade, which is a little surprising. Just by looking at all other guys, just by looking at the massive repricing of all these boys lower, of Walmart lower, of everything else in this area, and competitors signaling bearish trend. But Costco, they didn't have an amazing earnings date release, to be honest. Numbers were okay. They were okay. Just nothingness, just complete nothingness throughout the whole earnings call. I've listened to the whole earnings call, but I guess in this environment, nothingness and stability is good. So okay, They said they're not planning on raising their subscription fees. So I guess the market reacted to that positively. But right now, we shall see. We shall see if we're gonna get another move and repricing of Costco higher. But let's see how the week opens. But it's an interesting place to be considering longs in. Okay. Nothing else of interest, to be honest. No nuclear longs, no crypto longs, no transportation and shorts. Oh yes, no. Another interesting thing to highlight. We've opened a 16 delta straddle. Sold a strangle. I'm sorry. We sold 205 and 155 strangle before the earnings, and we've got. I mean, we did that by the book, and on the open, it opened right here. I've listened to the call. I've sat through the whole call. Holy shit, the numbers are so bad. I don't know what the hell this company is doing with what $40 billion in capitalization and 150 to $50 per share. It should be trading much lower. We've been trying to short Snow, but it hasn't been the best experience. I'm certain we will get that right at some point when we get a general repricing of market lower, and Snow will be one of the best shorts. It should be one of the best shorts, and I will gladly ride it below $100. But right now, what we did, at the open, before the call and before the market close, I've listened and I've seen the gap, how much it gapped from 175 down to 150, and I was thinking to myself, holy shit, we gonna get pounded tomorrow, absolutely pounded. But no, we closed the call. It was essentially worthless at that point, and we've been after this massive move. When the stock, the stock which is that volatile, gaps upward or lower, doesn't matter, gets a massive move higher or lower, it tends to, at the beginning of the trading session, it tends to do a contra move, just a small contra move, and we've been expecting when it gapped into this supply zone of interest. We've been expecting another repricing, just a small repricing higher, and as it repriced to 155, I sold the put, which right here was printing minus, what was it, minus $500. I closed that put at minus 280, something like that, and I've been very happy with that. So essentially, we've booked on one contract, we've booked minus $68 loss, $68 loss, which I was so happy with that. I was very satisfied with how we managed this position. Minus $68 right here. On Best Buy, we've sold Strangle on Best Buy. We've booked $75 per contract on Best Buy, and Lowe's, we've booked another $179 on Lowe's right here after the sold straddle on Lowe's as well. So this is the update. Generally, I am very comfortable of being long Nvidia SPY right now at this point. What to do with Nvidia, I have no idea. We will update you if we are going to take any position in ASML, Nvidia, TSM, or AMD, or any of the semis. But right now, at least don't short them. Okay, this is it.